I'm Brian Cooper.
And I'm Chad Urie, a Jones Lang LaSalle, and here's something to think about.
We're seeing tremendous changes in the life sciences industry, which is having an impact on the way that life science companies view their real estate. Is this segment of the commercial real estate market getting better? Yes. Would I consider it healthy? Not just yet.
Likewise, we're going through a transition of the ownership of life science real estate. We are moving from a specialty product type developed by local private developers to that of well-heeled REITs that have deep pockets and capital that's necessary to fund the improvements for these specialized companies.
The reality is companies are still having difficulty accessing the capital necessary to fuel research and expansion, and this is the most obvious obstacle to industry growth. The Great Recession has inflicted enormous damage on investment portfolios, including the pension funds and institutional endowments that have traditionally been sources of venture capital. In this capital-constrained environment, venture funds themselves have sought to reduce risk, reserving cash for their stronger companies with proven products and a clear path to market. Meanwhile, startup companies with earlier stage technologies and less predictable routes to commercialization have found it extremely difficult to raise money. In the San Diego market, where most of the companies are venture-backed, times have been tough. I'm constantly challenged by my clients to structure real estate transactions that provide flexibility around their internal funding events, and that oftentimes is at odds with the structures that the landlords prefer.
There's no question that the last 3 years have presented problems for companies in attracting venture capital. From 2010 to 2011 going forward, things seem like they're improving. Certain pockets throughout the U.S. tend to attract the most venture capital, namely Boston, San Diego, and San Francisco. We expect that those markets will continue to be strong going forward. These companies are also finding other ways of attracting capital. They're looking to big pharma, groups like J&J, Merck, Pfizer. All of these companies have patents that are expiring between 2011 and 2015 that need to be replaced. And those companies are looking at investing at early stage companies to replace those pipelines.
Further compounding the problem has been the virtual shutdown of the IPO market for biotechnology and medical device companies. We really haven't seen explosive life sciences growth since the late 90s, when companies were able to raise significant amounts of capital in the public markets. Many of my clients have tested the IPO market, but most are not receiving the valuations they need in order to file an S-1. In my opinion, even if venture capital funding increases and big pharma continues investing, we won't see significant employment growth in the life sciences industry until the IPO window is fully open. To put this in context, in 2008 and 2009, only 4 biotech companies went public. In 2010, that number increased to 14. This is a positive sign, but far from the number we need to see in order to experience significant growth and offset the employment losses across the sector on a local and a national basis. The end result in the real estate world is that transaction sizes are likely to remain smaller until this dynamic changes.
Although many companies had to take a discount in their pricing of their IPOs, the fact that they tested the market and some of them were successful is a sign that things are going to get better. This is very important in the scheme of the life science business plan because early stage capital needs to have an exit strategy, and the IPO window is the biggest exit strategy for these companies. So fueling growth over the next 10 years as far as it relates to real estate, the IPO market will be the most important.
The most important government-related factor in biomedical company success is the FDA. In recent years, after a series of high-profile product safety issues, the agency has tended to discount the benefits compared to the risks in ways that have dampened innovation. San Diego saw much evidence of this trend last year. One Jones Lang LaSalle client, Orexigen Therapeutics, received a significant boost when the FDA's advisory panel endorsed its weight loss drug, Contrave. However, during the last week of January, the FDA dealt the company a huge blow when it failed to approve Contrave, instead requesting a follow-on pre-approval cardiovascular safety study. This is estimated to take the company another 3 to 6 years to complete at a cost of approximately $100 to $200 million. This news put tremendous downward pressure on the company's stock.
The biggest challenge for the life science industry ahead is the FDA approval process. It takes too long, costs too much money, and right now the FDA is inclined to say no versus yes. Hundreds of millions of dollars are being spent ahead of time seeking FDA approval, and it's just not happening. And these are some really good drugs that probably should be approved. Companies that we represent are looking to other ways to drive revenue, and it's not here in the US. They're taking these same drugs, taking them to Europe, India, China, and saying, we can't get approved in the US, so we're going to do it overseas. The population's there to support revenue. If that occurs, the growth won't occur in the US, it'll occur overseas, and it's a major challenge.
Over the last 3 years, the considerable amount of excess space on the market allowed companies to take advantage of aggressive rental rates in higher quality buildings, a trend that we sometimes call a flight to quality. On average, Class A properties in each of the submarkets saw far greater transaction volume than Class B and Class C product. Many companies elected to do short-term renewals in order to maintain flexibility, drive down overall occupancy costs, and preserve precious capital resources. In fact, renewals accounted for approximately 1/3 of all the deals completed during the second half of 2010. On the other hand, my clients that were ready to make longer-term commitments have used this as a time to secure quality real estate with aggressive and flexible lease provisions at what we perceive to be the bottom of the market.
Demand for tenant space seems to be getting better. We've seen an increase in tenant activity recently and a decrease in availability. It's been led by markets of Boston and San Francisco and other parts of Seattle, and has been followed up with San Diego and other submarkets. The size range for tenant demand seems to be either early stage or late stage companies. Early stage companies are new company formation less than 15,000 feet. Venture capital is helping that segment out. And then larger companies in excess of 100,000 feet seem to be streamlining their operations under one roof.
One major trend in the ownership side of things has been investment capital buying out local, more homegrown developers. For the most part, this activity has been fueled by real estate investment trusts, or REITs, that are taking this time to grow their portfolio and establish solid relationships with tenants they think may be growing in the future. These REITs have access to significant capital, and generally speaking, they hold assets for a longer period of time. This has resulted in capital investments in projects that my clients occupy, which often makes their work environments more enjoyable and less susceptible to deferred maintenance issues in the future. I tell my clients it's a great time to anchor one of the REIT's new acquisitions that might be vacant, or take advantage of a REIT project that they're repositioning. In these situations, tenants can generally get a very favorable set of terms that you're not going to find elsewhere in the market.
On the West Coast, there's really 3 primary owners that control most of the life science real estate, and all of them are REITs. There's Healthcare Properties, there is Alexander Real Estate, and Biomed Realty, all of which play within the same space, have access to tremendous amount of capital, and are highly competitive amongst each other. There is always pressure to grow the portfolio size and generate extra cash flow and revenue as being part of a REIT. As such, most of the logical plays have been made at the local levels, and that's acquiring local real estate and acquiring local companies that control life science real estate. So these groups are going to need to look to other avenues to grow and continue to build upon in their portfolios. So I would suspect that you'll see a big push into corporate America, lab companies that own excess real estate or want to do sale leasebacks, and they're going to have to look at potential conversion plays of buildings that may support a lab conversion but not really our lab today, maybe office or industrial.
So to wrap up, I'm hopeful that we'll see increasing sources of capital to fuel innovation in San Diego in 2011, from venture capital money to public markets to increased grant funding. If that occurs, we'll see companies make broader commitments to the bricks and mortar they need in order to facilitate discovery.
So in summary, the changes in the life science industry are primarily being driven by the capital markets. And there's 2 sides to that. There's the tenant side, which has gone through a shift of raising capital from VCs to partnering with big pharma, because there's more funds and they're cheaper. On the landlord side, we've seen a shift of the local developer not being able to attract capital as well as the REITs because they have cheaper cost of capital. The end result is both industries should benefit from cheaper and more readily available capital. On behalf of Chad Urie and Brian Cooper of Jones Lang LaSalle, that's something to think about.